Hello YouTubers, welcome to Real Turkey channel. This is Atilla Yeşilada reaching out to you once again from a dark and gloomy Istanbul evening. That's when I do my best work. Sorry, this video is a sequel to my video on the prospect of a global debt crisis. It's delayed simply because responding to your criticism, I tried to install a new sound and studio program. I failed miserably, so I broke my PC, bought a new one, and installed the old program. So the sound and visual quality is going to be as bad as you are used to. But anyhow, why should I bother you with the techno problems of a boomer? Let's get to the topic of today. Can you have any guesses? Well, of course, it's going to be about bad mouthing Turkey, how bad things are in Turkey, how the economy sucks, how the politics suck, how we are imminently facing a crisis. This is essentially the theme of Real Turkey channel, everything that goes wrong in Turkey. Why do I do it? Do I make any money out of it? No, not really, but it's a hobby. I mean, it's a dirty job, but somebody gotta do it. So I sort of like owned up to the task. And also, it's a great way to blow off steam. If you know if you live in Turkey, you would know what I mean. Today, we're going to talk about debt crises, and in particular, the potentiality of debt crises in Turkey. Why am I bothering to bring up the subject of debt crises? Well, that's because if you follow the world economy, wait a second, I think I saw something. I talk about debt crises because everyone else is just a second. No, 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 please don't turn it off. I'm here. Well, I follow the world economy through the quarterly reports of what we call the supranational institutions like World Bank, IMF, UNCTAD, OECD, Bank of International Settlements, International Finance Corporation, International Institute for Finance, and all of them suddenly start talking about debt crises, debt crises, debt crises. In fact, here's a Reuters report from the most recent IMF World Outlook report, which says ticking bombs, the risks the IMF sees to financial stability. Financial stability is a polite word that these supranational institutions use for debt crises or financial crises, which are not exactly the same, but in practice pretty much occur at the same time. To give you an example, Sri Lanka defa- defaulted on its foreign debt this year and it got really ugly. They had riots and stuff. Today, before I started preparing this video, I read that Egypt has put restrictions on individuals' withdrawals from their FX bank deposits, which is the slippery slope to capital restrictions, capital controls, and then eventually default. Essentially, this is the situation. For boomers like me, who has been around since the mid of the 20th century, the last 20 years have been exceptional. Not only in the last 100 years, but maybe in the last 400 years, we have never seen such an episode of uninterrupted lose money policies. In other words, 20 years when money was very cheap, everyone got credit without too many questions being asked. There were several reasons for it. Preventing financial crises, preventing economic recessions and the pandemic, etc., etc. But essentially, for 20 years, the global currency dollar was cheap to borrow, so everybody borrowed. So much so that since 2018, global debt rose by $50 trillion. You might ask, global debt to whom? Well, obviously, the bankers from Alpha Centauri and the Martian money changers. Everyone knows that. I mean, even Pentagon admitted to UFOs. I'm not a numbers guy, so I'm just going to give you a ballpark figure. But by the end of the second quarter of 2022, the debt to GDP ratio of the world was something like 320%. Again, the point of these videos are not spewing out a huge number of numbers to confuse you, but to get the message through. And the message is that 20 years of easy money policies have ended this year when led by American Central Bank Fed, all the major central banks, with the exception of China and Japan, started hiking interest rates. So now we're living in a world of tight monetary policies. Of course, when dollar was cheap or your local currency was cheap, everybody borrowed. Households borrowed, companies borrowed, nations borrowed too much. And now we find ourselves at this juncture in the world economy where economic growth is slowing drastically, which means you are going to make less money, companies are going to make less money, and the treasuries are going to raise far less in tax revenues. On the other side of the equation, the interest rate on your outstanding debt is rising month by month. So, an increasing share of your revenues and income is going to servicing your debt. There's another problem. All debt has a maturity. When your loan expires, you usually go to the bank to get another loan. You roll it over, you let it float. This time, when you go to the bank may say, well, your credit score is too low. Sorry, guy. You got to pay off your debt. We're not going to give you a new loan. That's where households find themselves, but it's also where nations and companies find themselves. This is what brings the threat of financial instability to the fore. I mean, for individuals, companies, nations that have huge cash reserves, savings, wealth, and a steady income flow, even at higher rates, they can borrow again, and without impairing their other activities, they can service that debt, pay monthly interest rates or quarterly interest rates. Not everybody's finances is in order. And that's exactly what's bugging IMF. The ticking time bomb is millions of small and mid sized companies across the world that have taken on too much debt over the last 20 years, and roughly 30% of developing nations, we call them emerging markets as well, the finances of which are very fragile, so much so that they cannot possibly be expected to pay off their maturing debt, Eurobonds, they are called, or local currency bonds, when the time comes to roll it over. And Turkey is certainly one of them. Uh, Turkey is headed for a debt crisis. In fact, I'm going to argue that Turkey is headed for three different debt crises sequentially. But before I start, to make sure that I'm not making this up in my addled mind, let's look at this article by Euronews, which is titled Soaring Inflation and a Collapsing Currency. Why is Turkish economy in such a mess? And it explains the reasons. The leading reason being our president, Mr. Erdogan, pursuing insane policies. This guy doesn't believe in interest rates. He doesn't believe in tight fiscal or monetary policy. He thinks Turkish economy can grow limitlessly if you just give cheap credit to businesses, and that inflation doesn't matter. These are all his actual statements. So obviously, there is huge amount of concern about the debt crisis in Turkey. How do we measure this concern? Is it just in my words, in the statements of the financial press? No. We look at two things. The first is the credit default swap price, which is essentially an instrument that protects the borrower against the default of the lender. It's sort of like an insurance policy written by a third party, which says, look, you pay me a premium, and If your borrower defaults, I'm going to make you good on the money outstanding. Turkey's credit default swap premium on a 5-year credit default swap is currently around 800 basis points. So 8% for, every $1,000 you borrow, something like that. Is this high? Yeah, it's very high. The average for the league of countries that are similar to Turkey is something like 450 basis points, 500 basis points. For United States, it's something like 50 basis points. Essentially, anything above 800 basis points tells you that your lenders think you have a high probability of default. The second thing we can look at is the interest rate or the yield on the outstanding euro bonds, dollar and euro bond obligations of our treasury. I think the average 15-year dollar euro bond is trading with a yield of something like 10%. Once again, remember, the American Treasury pays 4% when it borrows at a 10-year maturity. So Turkey has a 600 basis point spread over American Treasuries. Is this bad? Yeah, this is fairly bad. Your IBMs, your Apples, your Microsofts would borrow at 50 to 100 basis points above what the Treasury pays. Even junk companies would borrow at 450 basis points above the Treasury yield. So Turkey paying 600 basis points higher than the American Treasury once again shows that investors in Turkish debt, Turkey's creditors have lost a lot of faith. In what shape will we see these three debt crises? The most imminent is a balance of payments crisis, which simply means you have this external deficit you need to finance, but you don't have enough hard currency to do so. And that's where Turkey finds itself. The math is very simple. We're in October now, but latest data is from August. So from September to the September of 2023, Turkey will accrue roughly a $50 billion current account deficit. In addition to that, because it has become very difficult to borrow and very costly to do so, Turkish banks and non-financial corporates will also pay off part of their maturing debt. Let's say this sum is roughly $20 billion. Again, this is not an exaggeration because Turkey's foreign debt maturing in a year is $160 billion. So I am assuming only 1/8 of that will not be rolled over or borrowed again, but the borrower will choose to pay. So Turkey is looking at roughly $60 billion of foreign financing. Does Turkey have that? No. When banks and corporations need to pay off their foreign loans, they go to the central bank, which is the store of most FX holdings in the country. We have an external deficit financing requirement of $60 billion in the coming 12 months. And the central bank's FX reserves, which can be used to pay these debt off, is around $35 billion. Now, if you look at official data, the central bank reserves are something like $110 billion, but most of these assets are not liquid. They are country swaps in local currencies, gold, and other assets which cannot be immediately converted to cash if there was a demand on them by banks or corporates. Once again, math is simple. We need $60 billion to make ends meet in the next 12 months. We only have 35. Foreign money is not coming in because nobody is happy with Erdogan's policies. And moreover, Turkish citizens are holding roughly $170 billion of foreign exchange deposits, which they have no interest in changing to Turkish lira because the interest rates on Turkish lira deposits is something like 13%, whereas inflation is 80%. Now, you see where I'm going with that. At some point, this will blow up. We don't know when. Erdogan is aware of that. So he's touring the world looking for money to fund the current account deficit. So far, Arabs said no, London bankers won't lend. Putin might. Putin will not send cash to Turkey, but he's amenable to selling oil and natural gas at a discount or even on credit until Turkey's financial conditions improve. This could provide some relief, but there is a catch. The catch is, of course, Putin is not the kind of guy who is very generous, who would just help you out because you are his friend. There is reciprocity, quid pro quo. In other words, Putin wants something in return. What might he want? Well, the Western nations think Putin wants Erdogan to turn a blind eye to Russian entities bypassing sanctions through Turkey. And of course, the West is extremely unhappy about that, simply because they think Putin is sunk into a morass in Ukraine and they have a once in a generation chance to get rid of Putin and to sink Russia's ambitions to become a global player. So they are not going to let Turkey easily off the news because Turkey is the only country that may provide Putin with an outlet to avert or avoid these sanctions and to prolong the life of his regime and the war in Ukraine. In other words, even if there is huge amount of funding from Russia to cover our current account deficits, it's not going to help much because the West is going to slap sanctions, at which point Turkish depositors will want to withdraw their FX deposit from banks or foreign banks will not lend to Turkey. It all amounts to the same thing. So this is our first debt crisis, an inability by the government, but most likely by companies and banks to pay off their maturing FX debt, not because they don't have it, but they lend it to the central bank, which has wasted it. This will probably happen sometimes between now and the next elections, which are going to be held probably either in May 2023 or in June 2023. The second debt crisis will happen right after the elections. I've shot several videos explaining my viewpoint that Erdogan will lose. He will not be the president, the opposition candidate, possibly Mr. Kılıçdaroğlu, will take his place, and his AKP-MHP alliance will lose parliamentary majority to be replaced by a loose coalition of 6 centrist parties plus the Kurds and the leftist parties. The first thing the new government, the new president will do is to normalize monetary policy. Let me just tell you what is going on in this country. The central bank's interest rate is 12%, whereas inflation is 80%. This is highly unusual. Now, at times, the central bank interest rate does lag behind inflation, but central banks try to catch up immediately. They try to raise their interest rates above the going rate of inflation or trend rate of inflation to suppress it. Erdogan wants to do the opposite. He wants to cut interest rates to zero. So if he goes, we'll have orthodox monetary policy, which means that interest rates will have to be hiked, not immediately to 80%, but doesn't matter. They are 12% now, they'll have to be hiked to 30%, 40%. But there's a huge problem with that. I, the consumer, have borrowed at 20%. You, the corporate, have borrowed at 25%. These are all relatively short term loans. They mature anytime within the next 3 months to 3 years. And when you go to your bank to renew these loans, the bank tells you, well, sure, but the new interest rate is 40%. We can afford 20%, but probably we won't be able to afford 40%. And this is not a situation that will go away if you wait long enough, because monetary policy will start tightening at 40% and then will go up to 50, 60 until inflation is down to 5% from 80%. In other words, a huge number of consumers and corporations will be unable to borrow or pay off their maturing loans. There will be there will be a huge number of personal and corporate bankruptcies. That's the second phase of the debt crisis. But we don't end there. Assuming the global high interest rate environment will last for a few years to come, Turkey, as well as other nations, including United States, will have to deal with the zombie companies. Companies whose business model are no longer viable. Companies who cannot turn a profit under free market conditions, but they survived by simply increasing their leverage. That's their debt to capital ratio. They don't make any money, but they can service their debts, and they're hoping to survive in a better future. If that better future doesn't come, these zombie companies must be somehow retired because their presence hurts the ability of sound and younger companies to borrow. And that is the trickiest task, not only for Turkey, but for all the nations and their monetary authorities to somehow put these zombies to rest without hurting financial stability and, of course, employment or the viability of their banks. And that will be the final phase of Turkey's debt crisis, which will probably come sometime around mid 2024. Well, this has been a great video. It certainly cheered me up. I hope it cheered you up. And assuming I don't smash my PC once again or my studio program works, I'll soon broadcast another video telling you how bad things are in Turkey. In the meantime, stay safe, stay mentally sound. This is Atilla Yeşilada saying goodbye from Istanbul.